Hello and good morning friends, welcome to the CEC-UGC live lecture. Dear friends, with our ongoing series on financial management, today we would be talking on capital structure. This is the first lecture on capital structure and we would be discussing more on capital structure in our forthcoming session also. Dear friends, under capital structure today in the first half we would be talking on factors affecting capital structure and assumptions of capital structure theories, whereas in the second half we would be discussing on net income approach and net operating income approach. And for this very discussion we have once again with us in our studios Dr. Amarjeet Kaur. Dr. Amarjeet Kaur is a professor of accounting. She is a dean of a management school in one of the reputed institutions. She has authored numerous books on accounting as well as in other elite areas. She is a certified management accountant from USA. She is participating and she has contributed a lot to various journals both at national and international levels. So let's welcome our guest Dr. Amarjeet Kaur and let's try to grab maximum knowledge through her. Hello ma'am, welcome to today's lecture.
Hello Geetika, very good morning. A very good morning to viewers and welcome back on yet another session in financial management. As Geetika introduced, we would be talking about capital structure theories in today's lecture. Capital structure is the part of second financial decision. We have mentioned for times there are three financial management decisions. First one is investment decision, second one is your financing decision, and third one is dividend decision. So there are three important decisions which we take in financial management. We have covered investment decision in length. The second decision, financing decision, which we started 2-3 lectures ago, where we covered cost of capital, how to calculate cost of capital for a specific source, and then weighted average cost of capital. This was discussed in the previous lectures, and today we are going to talk about the second important topic of financing decisions, which is capital structure theories. In the capital structure theories, we have 4 theories. We would be talking about 2 theories in today's lecture, and remaining 2 theories would be covered in the future lecture. So before we talk about capital structure theories, let's understand what is capital structure, what are the factors affecting capital structure and the assumptions behind theories. So that's what we are going to talk in the first half. In second half, we would be talking about theories of capital structure. Alright. Financing, as we know, is something which pertains to liability side of the balance sheet. Financing means you decided to buy asset XYZ that pertains to asset side of a balance sheet. And now next question comes, once we decide where to invest, which particular asset to buy, our next question comes in how to finance that asset, right? So it means today we are talking about liability side of a balance sheet. So liability side, as we know, generally pertains to equity, debt, term loans, project loans, like that, preferential capital. So such headings are there in the liability side. You would be able to recall, if you have studied accounting, you should be able to recall this, right? So the point I am making is this: in the financing structure we decide how to finance our assets which we decided to purchase through investment decision. That is what is deciding in the through the financing decision. Now financing could be through debt capital or could be equity capital. Broadly, we divide all the available sources into 2 categories: debt category and equity category. So debt category means it could be project financing, it could be term financing, it could be debentures, bonds, etc. Whereas in the equity we talk about equity share capital and preferential capital. Now so broadly we divide all the sources of funds into 2 parts, debt and equity, for the purpose of discussing theories and otherwise understanding financial literature and financial theories, right? So the next question is, what is optimum capital structure? The capital structure and optimum capital structure, two things. So capital structure means the proportion of debt and equity funds into the total finances used in a company, in a business. So if we are using X amount, if I am using 100 crores, so out of 100 crores, how many crores I have borrowed from debt funds, and how many crores I have actually raised through equity capital. So that is what is known as capital structure, means the ratio between debt and equity, or proportion of debt and equity funds basically decides or talks about capital structure. Now, what is optimum capital structure? There is one very important term used in literature, optimum capital structure. So, optimum capital structure as established in the literature means a structure where the cost of capital is minimum and the value of the company, of the business, is at the maximum. It means when my overall cost of capital, which is also known as weighted average cost of capital, WACC, KO. So we discussed in the previous lectures. So cost of capital is minimum and the value of a firm is a maximum. If that situation is there, that is what is known as optimum capital structure. It means the theory of optimum capital structure dictates or advocates that we should try to have such a combination of debt and equity in our total financing, that which leads to minimum cost of the capital used by a business. So because why I am saying so, weighted average cost actually can influence the overall cost of capital by just changing the proportion. We understand the cost of capital for different sources of funds is different. Debts are cheaper sources of funds, equity are most expensive one. Retained earnings are also expensive one, but preferential is in between, it is a hybrid source, right? So cost of capital, basically the overall cost of capital depends on the cost of specific source which we use and the weight, how much percentage of that particular source is used in the total fund decides the overall cost of capital. So my value, my business would have maximum value if my cost of the capital I use is at the minimum. So that's what the optimum capital structure theory says, right? So let's talk about factors which affect the capital structure theory. There are many factors. The most important one are profitability and solvency. So let's talk about these two, and we will talk about the others and later, after a few minutes from now. Profitability means the profit earning capacity of a business. It's different than profits, right? We discussed somewhere in the past. So profitability, how much profitability we are targeting at, right? What are our targets to earn profits? So that will decide the cost of capital. Why? Profitability means the rate of return on the capital used, the profit earning capacity of the capital, the profits earns, right? Interest is something which is paid on debt funds, and this is an item which is deducted from the operating income to calculate taxable income, right? So it means it is a tax deductible item, whereas dividend paid on equity is not. So profitability of a business is affected by either the debt funds are used or the equity funds are used. Your profits goes down if you are paying interest on the debt funds. But your net income after taxes may be higher because you are going to save taxes on the interest income, right? So profitability is one of the important factor. Then solvency. Solvency means how solvent a business is to meet up its long-term liabilities. So, long-term liabilities may include debentures to be paid off, to be redeemed, preferential capital to be redeemed, term loan to be redeemed after some time. So, the point I am making is here how solvent we want it to be perceived in the market, or what is our philosophy as a business, our mission as to keep our solvency level. If we want it to be perceived as a very solvent company, means we are using minimum debt funds, then definitely we would be using more of equity capital. But if we are not worried about that how we are perceived when it comes to solvency, then we may use debt funds. So, what is the philosophy of the management that will decide the combination of debt and the equity used in the capital structure? So, other than that, there are many more factors. You can have a look here. Control, first factor here at the top. So, control means there is a difference between the control power when we use debt funds and the controlling power when we use equity funds. When we use debt funds, the control remains with the equity shareholders, right? But when we use equity capital, the management control goes into the hand of shareholder, right? So, if we are using more equity funds as a business, we should be prepared that we would have many more interferences, many expected interferences in the day-to-day operation through the voting powers shareholders have. So, they do vote in the general body meetings of the company. They do vote for many issues in the management decision making, right? So, control is something which is another factor which would be taken care while deciding that we should be using debt funds or equity funds. So, debt and equity funds they have a different controlling proposition. Debt funds doesn't dilute the controlling power because it doesn't give any, debenture holders do not have any controlling rights, whereas equity shareholders have controlling right through participation in management by voting, right. So, this is one important, this is what we discussed when we discussed sources of capital, sources of long term capital. I hope you would remember that. So, controlling is yet another factor which decides the proportion of debt and equity into the capital structure. The next is business risk. Business risk means the variability in earnings we expect and we actually receive. So, if I am expecting X amount of profits and my actual profits are Y amount and there is a difference, that variability, that variation is basically known as business risk. So, how much risk a business is at to earn its expected earnings is known as business risk. So, if I am at a higher risk of business risk, if my business risk is at a higher side, then I may not like to take debt funds because I would have a regular obligation to pay interest charges as well as the principal money. So, businesses having a higher business risk would avoid using debt funds or may use at a minimum, whereas businesses which have a higher, which do not have higher business risk, which have lower business risk, if I put it other way around, then those businesses may like to use debt funds because they have a low business risk. So, this is important factor which decides the proposition of or the proportion of debt and equity fund in the total capital used in a business. Moving forward, the next point is financial risk. So, financial risk means the capability or a risk of being not able to pay interest on the debt funds. So, that is known as financial risk because interest is considered as a financial charge, financial obligation, financial cost. There are many words, many terms which we use in financial literature. So financial cost or financial obligation, which is towards payment of interest and principal money, but here we are talking about only interest charges. So variability of the risk that a business may not be able to pay the interest obligation or meet up or interest obligation is known as financial risk, right? So how much is the variability expected will decide the extent of financial risk for a business. So businesses which are at a higher financial risk again may not like to use debt funds. They may like to use equity funds. So this is another factor which decides the proportion of debt and equity funds in the total funds we use. The next factor is return to equity shareholders. So how much returns are expected by the equity shareholders is also another factor which will decide about the capital structure of a business. Return to equity shareholders may vary from industry to industry. If there is a trend to pay a certain percentage of dividend, which is basically return, if there's a requirement, then company may like to use debt funds as well. But if there's not much expectations, so company would be free to use all funds as equity funds. So how much dividend payments are expected by shareholders would decide about the proportion of equity funds in the capital structure, right? Moving forward, tax consideration. Tax consideration means how important it is for a business to respond or consider tax slabs or tax payments. Why I am saying so? Because the interest which we pay on the debt funds, that is a tax deductible item, whereas dividend is not. On dividend, a business has to pay additional tax, whereas on the interest dividend, a business saves in taxation by the percentage of the tax slab we are in. So this is another taxation is another important factor which decides that how much debt or how much equity would I be using in my capital structure. The next is cost of capital. Yes, cost of capital is important factor, a very important factor in fact, and it is different across countries, across sectors, across economic zones, even within a country, right? So it all depends where and which sector the investment is required, which particular business is going to ask for debt or is intending to raise capital. So there are many factors which decide cost of capital. Another important factor is that cost of capital which we use is not common. We do not have a blanket rate for all businesses even within the same industry. The industry would be different, but the cost of capital may vary from business to business. What is the reputation of the business which is seeking for the loan or which is keen to raise capital? What is and how old the business is? How has been the experience of shareholders and debenture holders in the past? What is the perception of investors about the business in the market? Right? These are the factors which decides the cost of capital. Since the cost of capital varies from business to business, so business need to consider what is the cost of capital to it before it decides what should it be using as a source of capital. So, but either the debt should be more or equity should be more in my capital structure would based on how much debt cost me and how much equity costs me as a business, right? Moving forward, trading on equity. Trading on equity is basically an interesting term and very important term. Sometimes I have seen interviewers asking this, what is trading on equity, to finance students. I keep on telling my students, MBA students, to be familiar with this term, to understand this term. Trading on equity means the difference between what we pay to interest, as interest to debenture holders or bonds, to debt funds, and how much we earn overall on the capital employed. If my total capital employed is 100 crore, I am earning 12%. So my earnings on total capital employed are 12%, and if I am paying 8% on the debenture, on the debt fund to the debenture holders, so the difference of 4% is basically something goes to the kitty of equity shareholders. They enjoy the difference. So trading on equity means the difference between what is paid as interest and what is earned on the funds which belongs to debenture holders in total. So over and above the cost of debt. So that is the difference which goes to equity shareholder. So what is the policy, or what is the perception of equity shareholders, or what are the expectations, rather I should use this word, of equity shareholders towards trading on equity? This will decide the capital structure of a business. Moving forward, the next is investors' attitude. What is the investor attitude towards debt and equity? If there's in economy, the investors in general do not like to invest in debt funds. So no business would be able to raise debt funds. It could be some other factor in the economy itself. It could be some social factor. There are few religions, I would not like to name, that particular religion do not want, the people of that particular religion, they do not want to use debt funds, right? I hope you understand what I am referring to. So it all depends. So investors' attitude, they want to invest or not in debt funds, would decide the company can use them or not. Investors' attitude that they want to invest in the stock or not. It's not only the attitude towards debt, it's the attitude towards equity as well. So if investors are ready to take risk, because we know the equity funds are more riskier than debt funds. So if investors are ready to invest in equity, so no one can stop. So investors' attitude would also decide what should be the proportion of debt and equity in the capital structure. Moving forward, legal provisions. Legal provisions means there could be a possibility. Every country has its own legal provisions. Even in our own country, a new business in the first year cannot get into debentures, cannot issue debentures, debt funds. So what are the legal provisions pertaining to debt funds, pertaining to equity funds, and where do I fall as a business? That will decide which particular source can I use as my source of capital. So my capital structure would depend upon the provisions, the legal provisions prevailing in my country where I am operating from. Yeah. The next is growth rate. So the growth rate of the business and growth rate of the profits, the both will decide, the capital structure of the company. This is one of the factors. The next point is the purpose of financing. Purpose of financing means, do I intend to borrow for paying back my debenture holders, redeeming my debentures, or I am raising funds, either equity or debts, for the purpose of investing in a new project, for modifications, for expansions. So if I am just raising funds for the purpose of paying debenture holders, I may not get many seekers to the raise, right? The fund I am raising. But if I am having ample opportunities for growth in my business, and I should be able as a business to raise debt as well as equity relatively. So both of them would decide, the purpose of financing would decide what would be the proportion of debt and equity fund in the total financing. The last point here is period of financing. Period of financing decides whether equity would be available, or debentures would be available, bonds would be available, term finance would be available. There are different sources, though they all fall under two category only, either equity or debt. We can actually put them fairly under two categories only. So period, why I am saying so? Period of financing means for how long do we need financing. If I need a short term financing, then I am not going to raise debenture. I may look towards my banker, right? I may look towards a bank overdraft facility. I may look towards small short term bank loan. I may look towards some other banking scheme to get small short term loan, right? So but if I do need financing for a longer term, then in that case I may have to raise long term debentures, long term bonds, or equity share capital. So this is another important factor which decides that how should I be financing. So to summarize, I would say it's not one factor which decides that what would be the capital structure or how the financing of the funds needed would be done for a business. All these factors, they do influence all businesses. Definitely they affect relatively. Few of the businesses would be affected by few factors more than the others. Nevertheless, almost every factor is important and affects the financing structure of a business. So this is all for this module. Thank you very much for watching. Thank you. Very good afternoon to you all and welcome back in the second module. In this module, we will talk about theories of capital structure. So I hope you are with me when we talked about the factors affecting capital structure. So today we will discuss two theories, net operating income approach and net income approach. So both of the theories have been introduced by Professor Durand, a researcher, a renowned researcher in finance. So Durand has introduced two theories, net income and net operating income approach. So before talking about the theories, let's talk about assumptions pertaining to the theories. So all the theories of capital structure are, in fact, not only capital structure, otherwise the theories are always are based on certain assumptions. So what are the assumptions in capital structure theories? The first assumption is that there are only two sources of finance, which is debt and equity. The second is the financing and investment decisions are constant. It means if I am using X amount, then my requirement remains same, and investment decisions also remains constant. Another assumption is capital structure would be optimum when the cost of capital is minimum. The company distributes all its earnings as dividend to its shareholders and no consideration of dividend and retention policy. The taxation and its effects on the cost of capital is ignored completely. The business risk is treated constant at different level of capital structure of a company, right? So there are no transaction cost and company can alter its capital structure without any transaction cost. This is an important assumption. Why I am saying so? Because in reality we do not get a chance to raise capital without spending on the transaction cost. We have to spend on the transaction cost, which means if I am keen to raise share capital, if I am keen to raise debentures, I have to spend on commission, underwriters commission, red herring prospectus, issue cost, so commissions, so many costs are involved when it comes to raising the funds. So but here the assumption is that there is no transaction cost, so that a business can switch from one type of structure, one type of financing source to the another source easily, from debt to equity or equity to debt easily. So this is what is assumed, right? And another thing is, it is assumed that earning before interest and tax remains constant, EBIT remains constant. So with these assumptions, now let's talk about the theories. So let's discuss about the first theory, net income approach. As I said, this approach, net income approach, was introduced by Durand. So Durand, there are three basic assumptions of this approach. Corporate tax do not exist. It means we completely ignore taxation while applying these theories. The second is, debt content does not change the risk perception of the investor. So debt content does not change. What does it mean? This is a very important assumption. It means if a company decides to incorporate more debt or replace equity with more debt or with debt, it means if I am putting more debt in the business, the risk perception of investors, especially of equity holders, would not change. It would remain the same. So they do not differentiate between a company which is not using debt funds and which is using a maximum debt funds. So they do not consider a difference between the two, which is of course debatable, which may not be true. I am not saying this is a correct assumption, but this assumption exists in this theory. And the third assumption this theory has is this: the cost of debt is less than equity. It means debt is a cheaper source than equity capital. So these are the three assumptions. Now that this theory advocates maximum use of debt funds so that the overall cost of capital, the weighted average cost of capital, is at the minimum and the value of a firm, value of a business, is at the maximum. Why we are assuming, I'm saying so? Let's have a look at the slide. Debt is a cheaper source. I am explaining the theory here. Debt is a cheaper source of finance than equity due to tax saving effect and investor risk expectations. Use of cheaper debt funds in the total capital structure will reduce the overall cost of capital and will increase the V. V is the value of the firm, right? So, as the degree of financial leverage increases, the overall cost of capital will decline and increase the debt content in the total fund would lead to value of firm going up. The value of firm will increase for every decline in overall cost of capital. I am at point number 3 where debt content is related to reverse will happen if weighted average cost will increase, thereby reducing the value of the firm. So, thus a firm can increase its value and lower its cost of capital by increasing the proportion of debt in the capital structure. So, what is the crux of net income approach? The net income approach suggests the use of total or maximum possible debt financing for minimizing the cost of capital. So, this in a sense we may say a change in financial leverage would lead to corresponding change in overall cost of the capital as well as the value of the firm. So, now let us discuss about what this theory says. Now, you have read it, you have seen it, I have read it for you. So, the theory net income approach says that a business should try to use as much debt as it is possible for it to fetch, right. So, why? Because the debt has a lower cost than the equity. And if you remember the overall cost of capital, the weighted average cost of capital WACC is dependent upon the proportion of each source we use multiplied by the cost of that specific source. So, it is WD multiplied by W1, weight of first item multiplied by the cost of, right. So, KD, cost of debt multiplied by weight of debt plus cost of equity multiplied by weight of equity. So, since this is weighted average cost, the moment we will change the proportion, the percentage of debt funds in the total capital structure, my overall cost of capital will go down. Why? Because my cost of debt is lower than cost of equity. This is an assumption though, but in practice we have always seen all the research carried out so far proves that cost of debt is lower than cost of equity. So, this assumption is quite acceptable made by Durand. So, that is why your overall cost of capital goes down. And why my value will go up? Because value of a business is earning before interest and tax, EBIT, divided by overall cost of capital. So, denominator is cost of capital, overall cost of capital or weighted average cost of capital. So, the denominator, if it is lower, will give us higher value, the V. So, V is value of the firm. So, V is dependent upon denominator and numerator both. But in this case what is happening, our denominator is going down because having lower cost of overall cost of capital. So, this is what works, this is known as effect of leverage. So, leverage is a very important and a powerful concept in financial literature. Leverage means existence of a fund or a source which has fixed financial charge. Leverage are used for financial leverage are used for operating leverage. In this in the capital structure we are talking about financial leverage. It means having a source of fund which has fixed financial charge on it. And debt and project financing, term financing always have a fixed percentage of interest to be paid, right. So this is what is leverage. So leverage plays a positive role as per the Durant's theory net income approach, and company should use the maximum possible debt funds. The higher the leverage of a company, the higher would be the value of the business, right? So we can present this in a graph. Have a look at a graph that how leverage works. Here on the x-axis we have shown the degree of leverage, and on the y-axis we have shown the cost of capital. So the leverage 0.1 means 10%, 20% followed by 30, 40, 50, 60%. So effect of leverage on cost of capital is shown through this graph. So what is happening, my cost of debt had been 5% and it remains 5%. Constant, irrespective I was using 10% or I was using 40% or now I am using 60%. So I am increasing leverage, which is the percentage of fixed interest bearing securities in the total funds. If they are going up, if my leverage is going up, my cost of debt is remaining same. So it means that the assumption the investors have no change, no preference for either the debt is used or equity is used. They perceive debt and equity equally risky, right? So there is no difference between the risk perception. So or you may say the risk perception of investors do not change if we increase the debt funds. So that is proving. Now in the second line, cost of equity was shown, and even the cost of equity remains 10%, right? So cost of equity also doesn't go up. So this is again as per the assumption that the risk perception doesn't change by changing the cost of debt. Since my cost of debt is 5% and cost of equity is higher, which is 10%, so the moment I use debt funds more from 10% to 20%, my cost comes down to 10 to 8. The moment I go further, it goes down further. So my overall cost of capital, which is KO, is going down by increase of financial leverage. That's what the net income approach says, right? So now let's have a look at the signs which are used by Durant to explain this theory mathematically. So V is the value of firm. Kindly follow my cursor. I am showing here at the bottom of the slide. V is value of firm. Value of firm is equal to basically the market value of E, equity or shareholders fund. Either of the one symbol would be there in any books you refer. So S is shareholders fund, E is equity, which is one and the same thing. So equity plus debt, E plus D, or you may see the symbol B, capital B, which is bonds, right? So the value of a firm is basically equity plus debt, which can be actually derived by dividing earning before interest and tax with overall cost of capital, so which is weighted average cost of capital, which is KO, right? So this is what the V is calculated as. Now what is how do we calculate S or E, shareholders fund or equity fund? It is market value of equity, which is actually E. So E stands for market value of equity, which can be calculated by dividing net income with cost of equity, right? And D or B, debt or bonds, are equal, market value of debt or bond, which denotes D, is equal to I. The annual interest, this is capital I, the annual interest charges divided by cost of debt. So that's how we calculate market value of equity, debt and value of firm. So market value of debt, in market value of equity, what is NI? NI is basically net income available to equity shareholders after paying dividend to preference shareholders and interest on debentures. And cost of equity is equity capitalization rate. So with these values in hand, let's go to and refer to a case and see how we actually calculate different values by using net income approach. So let's have a look here on this slide. This slide talks about the procedure. The procedure is how to determine earning before interest and taxation. So that is first step. If earning before interest and tax is given, well and good. If not given, then you would be required to prepare profit and loss account, income statement, and calculate earning before interest and tax by subtracting operating expenses and administrative selling or distribution expenses out of the revenue. So earnings before interest and tax charge should be there. Out of that, we subtract interest on debt funds, so which would be known as net income available. So the second step would be computing net income, which is EBIT minus interest. The third is we need to calculate market value of equity, which is denoted by E or S, as I mentioned earlier. So if we divide net income by cost of equity, so KE, it gives us market value of equity. The fourth step is compute market value of debt, which is I, interest divided by cost of debt. So B or D is market value of debt, and I is the annual interest charges for a business divided by the cost of cost of the debt for the business. The next is compute market value of a firm. So market value of a firm is basically sum of market value or value of equity plus market value of debt, or otherwise we can calculate value V by EBIT divided by overall cost of capital. And how do we calculate overall cost of capital is EBIT divided by V. So value is EBIT divided by overall cost of capital, and overall cost of capital is EBIT divided by V. It is just I am interpolating. So I hope you understood the procedure. Now let's take a caselet, small caselet, and see how do we actually calculate this cost of capital, the market value for a firm through a net income approach, NI approach. The case goes like this. A company expected annual net operating income EBIT rupees 50,000. It means EBIT is given in this case. The company has 10% debentures of 2 lakhs. The equity capitalization rate is 12.5%. Assuming no taxes, what would be the value of the firm under net income approach? So basically we have to calculate V, value of the firm as per net income approach. So we have been given the EBIT, we have been given debentures which are 2 lakhs and the rate of debenture is 10%, and we have been given KE, cost of equity, 12.5%. So with this data in hand, let's see how do we calculate. So here's the solution to the caselet. We will start with net operating income EBIT, which was 50,000. We will subtract interest on debentures 20,000. How did I get 20,000? 2 lakhs was the value of the debenture, 10% was the rate of interest. So minus interest gives you this 20,000. So EBIT 50,000 minus 20,000 as interest. The remainder would be your net income. So net income available to shareholders for distribution comes out to be 30,000. You can have a look at the slide. 30,000 is there. Now we have been given the capitalization rate for equity KE, 12.5%. So I can actually calculate market value of equity, which is S or E, is equal to net income divided by cost of equity. Net income is 30,000. If I divide it with 12.5%, my value would come out to be 2,40,000, right? So, the value of equity would be 2,40,000, which we calculated by dividing 30,000 with 12.5%. My cursor is showing that. Now, the market value of debt is already given 2 lakhs. So, if we sum up B and S, which is market value of shares 2,40,000 and B market value of bonds 2 lakh, if we sum them up together, it would be 4,40,000, and which is basically your value of the firm. So, 4,40,000. So, V comes out to be 4,40,000. So, the overall cost of capital can be calculated by dividing EBIT, which was 50,000, with V, which is 4,40,000. So, if you divide 50,000 with 4,40,000, you would end up getting 11.36, which is your overall cost of capital. So, I hope you could understand this, how to calculate cost of capital and value as per net income approach. So, moving forward, let us talk about the net operating income approach. So, this net operating income approach is also introduced by Durand only, but it is entirely inverse of what he said in net income approach. As per net operating income approach, there is no such structure, capital structure which is optimum. There is no such concept of having optimum capital structure. All capital structures are optimum, and leverage does not affect the value of the firm. This is what Durand said. Why? He said, as per the net operating income, he says, if a business is using leverage, it means debt funds, and decides to increase it, it means to use further debt funds in the total financing, the benefit of debt funds having lower cost would be neutralized equally by the increased cost of capital, which is implied cost. Which means he says implicit cost of equity capital would go up by the same value we save by using debt funds. It means it is neutralized. So whatever the benefit we have would be neutralized, and there would be no such benefit which could actually affect our cost of capital. Our cost of capital would be same as it was before using debt funds, because using debt funds leads to the rate increase in equity capital. So, the cost of equity capital goes up because of the risk perception of investors. They perceive debt fund as more riskier. So your overall cost of capital remains same, no benefit of using the leverage. So, this is the concept introduced under net operation. So, he himself actually challenged whatever he introduced at the first instance in net income approach, and he introduced the second approach, which is entirely opposite to the first one, right. So, let us have a look how does this net operating income approach works. As per this net operating income approach, the essence is that any change in leverage will not lead to any change in the total value of firm. That is what we discussed, right. The market price of shares as well as the overall cost of capital, hence the capital structure decision of a firm are irrelevant. The advantage associated with the use of debt, supposed to be a cheaper source of fund in terms of explicit cost, is exactly neutralized by the implicit cost represented by an increase in cost of equity. KE, it means KE goes up. Under this approach, optimum capital structure does not exist. Alternatively, all capital structure are optimum. So NOI approach also has certain assumptions. What are those assumptions? The investors see the firm as a whole and thus capitalize the total earning of a firm to find the value of a firm as a whole. So investor doesn't look firm differently. Either a firm is using debt or equity, it looks at a business as a whole, right? The next assumption is the cost of debt is also constant and there is no tax which is levied. So these are the assumptions under net operating approach. Here is the graphical presentation of what we discussed. The graphical presentation says, here on the x-axis I am showing you leverage, on the y-axis I am showing you the cost of capital. So what is happening, the moment we increase cost leverage from 10% to 20%, my cost of equity, the line at the top, my cursor is showing that, goes up. If I go further, if I increase leverage to 30%, means I increase the use of debt to 30% from 10%, it goes further up. If I increase it to 40%, my cost of equity goes up further. So if it is 50%, it goes more higher. So we begin with 10%. My cost of equity was 10%. But by increasing my cost of, by increasing the use of debt, my cost of equity is going up and up by every single increase in the debt funds use, right? So what is the net effect of this? My cost of debt is lower than cost of equity. Cost of debt is 5%, cost of equity is 10%. So because of this, my overall cost of capital KO remains same, right? So this is the crux of the net operating income approach. So I hope you could understand it well. We will discuss a case on net operating income in the next module. I don't think my time will permit me to take a case on this. But nevertheless, I have covered both the approaches, and I hope you are with me to understand that how Durant changed his entire theory, because it's the same gentleman who introduced net income approach, and then later on he introduced net operating income approach. In the net income approach, so don't get confused by the name, because there's a difference of only one word, operating. So first approach is net income approach, second approach is net operating income approach. Net income approach, just to conclude, assumes that leverage plays an important role. The moment we use high leverage, our cost of capital goes down and value goes up for the firm. Whereas net operating income says no, leverage does not affect. Whatever the savings we have because of the low cost of debt funds is neutralized by the higher cost of equity funds, and overall cost of capital, your KO remains same. So this is the crux of net operating approach, means leverage does not work at all. And Durand is the guy who introduced both. So he actually contradicted what he introduced first. So I hope you could comprehend the discussion we had today. Thank you.
With this note, thank you, ma'am. Thank you so very much. And dear friends, your feedbacks are very, very important for us. Do write to us at info.cc@nic.in. We would be meeting again very soon and would be discussing more on capital structure. Till then, take care. Goodbye. Thank you, ma'am. Thank you once again.
Thank you, Geetika.